One of Africa's leading carriers, Kenya Airways, has once again reported losses for the 2021 financial period. However, CEO of the East African airline, Allan Kilavuka, believes the business will break even in the next 24 months. I spoke to Kilavuka earlier about the challenges and his vision for the business.
Business has been running at a loss. So two things I just wanted people to always remember. The first is, indeed, in 2020, we recorded our record loss, but that was not surprising at all. I think all airlines in the world recorded negative results. And so what we have been doing since then is to grow from that crisis. So to improve our performance from that record loss that we recorded in 2020. So if you look at our performance right from then on, we have had significant and consistent improvement, both from a top-line perspective and also from a cost perspective, and therefore from our net loss perspective. So yes, indeed, it's true. We've been recording losses for the last many years. I choose to see it from a going forward perspective. What are we doing today to make sure that we get out of a loss situation, improve our balance sheet, and more importantly, to make sure we have a sustainable growth strategy?
What are you doing right? What has led to you cutting back on the losses and certainly increasing the revenue that you're enjoying at the moment?
There are a few things that we're doing. I mean, if I were to summarize, I would say first point is to maximize on our profit line. So optimize our network so that it's an efficient network that is able to generate as much revenue as we possibly can. We also did a lot of diversification of our products, including even our product on board, see how we can generate more income from an ancillary income perspective, but also other revenue streams like cargo, for instance, and also our new product line, which is our drone subsidiary, which is operating an unmanned aircraft operations. And then we have our cost line, which is to look very keenly on our costs, the big cost line items, and to significantly shrink them in line with our operations and also to be in line with best practice across the world. A good example being our lease costs, which we have been working very hard at. So in 2021, we got our one-off concession. This year, we are discussing with our lessors to get a permanent concessions from our rentals. We were targeting 35% reduction in cost. We believe we'll be able to get 19% overall reduction in our cost of leases. And then lastly is just culturally, to be able to sustain this transformation, we have also to transform the culture of the people and focus more on how do we make our customer experience a lot more happy so that we can retain our customer base. How do we make sure that the people in the company are passionate about coming to work every morning and they are focused on the right things, including making sure that we are keeping the assets of the company safe. So we are working through what we're calling a culture transformation process of the employees so that they can focus on the right things and have the right passion to help transform the company.
Well, your tagline is the pride of Africa, so I'd imagine there's a huge amount that's going into that transformation. So where are you now and where are you moving to in terms of that work culture that you speak of, Allan?
We are in the middle of overall transformation. Okay, we believe that we'll be able to at least break even by 2024. Okay, so we don't believe that we'll be able to be profitable this year or next year, but we are confident that we'll be able to break even by 2024. How is actually what I already mentioned, which is top line stimulation of revenue. Then secondly, continuously looking at the cost line to take out wastage, unnecessary costs and become more efficient. And with the permanent concessions that we are gunning for, we believe that after we have a full complement of our capacity in 2024, we should be at least break even and then grow from that basis.
That's obviously huge ambition. But one of the key challenges, obviously, is the cost of fuel. And we do know from your statement that fuel contributed heavily on your increased costs. When we look at the cost of fuel currently back above $100 a barrel, the end of that Ukraine war is nowhere near in sight. how are you going to deal with certainly costs like fuel that you really have no control over?
We unfortunately don't have open lines for hedging, because that's what we would typically do. We do fuel hedging. We don't have lines for hedging at the moment. And in any case, I think it's not the right time to hedge because the fuel price is quite high, so it's an expensive exercise to undertake. But we look for the earliest opportunity for us to get in and hedge so that we can mitigate on the cost. However, what we are now doing is to reduce the fuel burn on our fleet. We noticed that with the increase in frequencies because of peak season, our fuel burn was worsening. So we want to improve that by about 10% so that it will help to reduce the fuel consumption. We are also very careful where we are fueling our aircraft, because fuel cost is different in different destinations from where we fly. So we try and fuel at the cheapest possible destination. And then lastly, of course, to make sure that we have, and in line with fuel burn, is our loading of the aircraft. So we don't have unnecessary load. So we burn less fuel as we fly. So, we are working on those. Now, apart from fuel, of course, we have other factors that are beyond our control. For example, we have Forex. The Kenya shilling has lost significantly. Actually, not just the Kenya shilling. All currencies seem to be losing quite significantly against the dollar. That impacts our costs, financial costs. Same with the interest rates, which are really going to shoot up, particularly in the second half of the year. That's another factor that is really going to hurt our results as well in the next year. But this situation is not permanent, right? So although it's going to hurt us in the second half of the year, we believe that it will relent. And like you rightly said, we don't know when, but it will relent. And at the earliest opportunity, when we can do some sort of hedging or mitigation, we will.
Yeah, so you've signed that code-share agreement with South African Airways in anticipation of a Pan-African airline. Talk to us about the merits. What led to the signing of this agreement, and what are the benefits that will accrue to Kenya Airways, in fact, to both airlines?
Now, this is not a novel idea because it has been done before. It has been done in Europe. It has been done in the US, where carriers have come together, consolidated, so that they can approach the market together. Now, that also helps them to reduce their overall costs, and specifically unit costs. It helps them to approach the market more coherently, so that the passengers who want to travel with them have a lot more connectivity. So overall, it will stimulate travel, reduce costs, and help to connect people across Africa, and also goods. Now, this is in line, again, it's not in a vacuum, so it's in line with the Africa Agenda 2063. It's in line with the Africa Continental Free Trade Area arrangements. So what we're working is, we're not working in a vacuum. We are thinking about how do we play our part in stimulating travel, in stimulating trade, and then in the process, help to sustain ourselves because we grow our business as well.